On the morning of March 30, 2026, three completely different people stared at the same wall of red numbers. Derek was standing in a grocery store parking lot, phone gripped in one hand, an iced coffee sweating in his cup holder, hitting refresh on his brokerage app for the 11th time before he'd even walked inside. He dumped every position at 10:22 a.m. He remembers the exact minute because he took a screenshot of it. Priya was at her desk at work. She never even glanced at the news. Her phone lit up twice with breaking alerts and she brushed them off like gnats, because 7 months earlier she had written a single sentence on an index card and taped it inside her desk drawer. Vivian is worth $300 million. Her family office rang her that morning. The call lasted 4 minutes. Nobody sold a thing. By the middle of April, the market had clawed back every point it had lost. 2 of those 3 people ended up ahead, and the smallest account in the group was one of the winners. Here's the twist, none of them saw the crash coming. Not even the woman with a small army paid to watch for exactly that. My name is Yank, and today I'm going to dismantle the most expensive myth in personal finance, your quiet suspicion that wealthy people get advance warning before a crash. You don't get one. They don't get one either. Nobody does. What they have instead is boring, mechanical, and mostly free to copy. And by the time this video ends, you'll be able to steal about 3/4 of it. If you've ever watched your account bleed red and felt like there was a private room you weren't allowed into, hit subscribe, because we're walking straight into that room right now. And before we go any further, I want to tell you something. If you've ever sold in a panic and then watched the market bounce back 2 weeks later, you are not the fool in this story. In a minute you'll see that you actually behaved better than plenty of professionals did. If that sounds hard to believe, good. Keep reading. Let's start with the actual data, because it wrecks the whole premise almost instantly. Every year, the Swiss bank UBS surveys single-family offices, the private investment arms that manage money for individual ultra-wealthy families. The families in the latest report average $2.7 billion in net worth. If anyone on earth gets a heads up before a downturn, it should be them. They get research reports you'll never see. They can literally pay a former Treasury official just to share opinions with them on Tuesdays. So here's what all that access bought them. 59% said they planned to run the exact same portfolio risk as the year before, and only 35% expected to change anything at all. And when a real crash actually tested that plan, most of them made no dramatic moves whatsoever. They described their own positioning using the least thrilling phrase in all of finance, all weather. $2.7 billion, and the strategy was to just sit there. Now, there is some counter-evidence, and you deserve to hear it. Capgemini, which surveys wealthy individuals rather than institutions, found cash sitting at 26% of the average portfolio at the start of last year. A year later, that cash share had dropped below stocks as money flowed back in. So somebody was moving money around. But look closely at the direction. They didn't rush into cash ahead of a decline. They sat in cash collecting interest, got bored, and then chased the market back up. That isn't foresight. That's exactly what you did, just with more zeros and nicer wallpaper. So if the most well-informed money on the planet isn't predicting downturns, what is it actually doing? The first answer is that wealthy people mostly aren't investors, in the way you and I use that word. They're owners. And that one distinction explains almost everything about why their march goes differently than yours. Here's the number that reframes the whole thing. The top 1% of American households hold roughly 53% of all the private business equity in this country. Not stocks, private companies. Ownership stakes with no ticker symbol, no price quoted every 11 seconds, and no way to dump them in a panic at 10:22 in the morning from a parking lot. And when the Richmond Fed dug into the survey of consumer finances, they found something brutal. For almost everyone on the wealth ladder, your largest asset is your house. It's only in the top 1% that business ownership finally outweighs the home. So if your net worth has never felt like theirs, that's the reason. Yours is a place where you sleep. Theirs is a thing that earns money while they sleep. Vivian's portfolio isn't just a bigger version of yours, it's a different species entirely. Nearly half of it sits in assets with no continuous price and no exit button. Your portfolio, meanwhile, can be liquidated during a commercial break. And here's where the finance industry hands you half a truth. Let me give you the whole thing. The half they tell you is that private equity holds up better during crashes. On paper, that's accurate. During the financial crisis, buyout funds fell less than 13% while the S&P 500 dropped around 40%. The half they leave out is that private assets get valued by appraisal, not by an actual sale. Nobody marks a regional plumbing company to market every 90 seconds. So a big chunk of that beautifully smooth line isn't lower risk, it's the exact same risk with the volatility quietly erased from the chart. It's not that the storm was gentler over there. It's that nobody sent them a photo of the roof damage. But that distinction matters less than you'd think, because the outcome is still real, even if the mechanism behind it isn't flattering. You simply cannot panic sell something that has no buyer. Illiquidity isn't a flaw in Vivian's portfolio, it's the safety mechanism. Paperwork protects her from her own worst instincts. Nothing protects you. You have a sell button, and it's always about 11 inches from your face. Which brings us back to Derek. Let's do his math honestly, because the usual version of this argument is lazy and you deserve better than that. You've probably heard the missing the best days statistic. Leave $10,000 alone in the S&P 500 for the 20 years ending in 2023 and you'd walk away with $75,242. Miss only the 10 best days during that stretch and you'd end up with $33,473. You'd lose more than half your money by touching your account 10 times, 10 days out of roughly 5,000. Now here's the part almost nobody includes, and leaving it out is basically a lie by omission. Morningstar ran the mirror image test. If you'd missed the 10 worst days instead, you would have beaten the market by about 2.66% a year. Missing the 10 best days cost you about 2.4% a year. Those numbers are almost identical. So the honest version isn't that market timing is mathematically impossible, it's that you'd have to be right twice, and those two events are welded together, because the best days and the worst days live right next to each other. The median gap between one of the 10 worst days and one of the 10 best days was just 7 days. 7. The market's biggest single-day rallies aren't scattered across calm, quiet afternoons. They're packed into the exact same 2 weeks when your hands are already shaking. To catch one of those rallies, you have to buy on the day the news is worst, the exact day every instinct in your body is screaming the opposite. Derek sold on March 30th. The bottom of the market was March 30th. He didn't miss the bottom by a little, he was standing right in the middle of it. And before you assume the professionals are immune to this, consider Warren Buffett's famous bet. In 2007, he wagered $1 million that a plain index fund would outperform a basket of hedge funds over 10 years. The index fund returned about 126%. The hedge funds returned about 36%. But here's the twist buried inside that bet, and it's basically this entire video in miniature: those hedge funds crushed it in 2008. They fell about 24% while the broader market fell 37%. They did their job perfectly in the exact year everyone feared, and then spent the next 9 years giving all of that advantage back. So understand what you're actually buying when you buy protection. It is never free. You pay for it in every single year that isn't a crash, and there are a lot more of those years than there are crashes. So if wealthy families aren't forecasting the future and they aren't buying elaborate protection, what exactly was happening on that 4-minute phone call that ended with nobody doing anything at all? Nobody made a decision that morning. They executed decisions that had already been made months earlier, and that's the one thing in this entire video you can copy for free before you even finish your coffee. That's the whole secret. Wealthy portfolios don't come with a better crystal ball. They come with a written instruction set, and a downturn is simply the event that triggers it. So let's build yours. 4 steps. 3 of them you can do this week, and I'll be straight with you about the 4th. Step 1. Rebalance using written thresholds, not feelings. Decide in advance that if your stock allocation drifts more than 5 percentage points from your target, you automatically sell what's up and buy what's down. No meeting, no gut feeling, no iced coffee sweating in a parking lot. I know that sounds like nothing. So watch what it actually did for people exactly like you. When Vanguard studied more than 5 million households through the March 2020 crash, 83% of ordinary self-directed investors made 0 trades. Only 9% actively rebalanced into the decline. Which means the story about panicky retail investors is mostly fiction. And here's the detail that should genuinely bother you: during this past March's downturn, buyers outnumbered sellers roughly 4-to-1 on the worst days, and the sellers skewed older and wealthier. The median age of sellers was 56. The median age of buyers was 40. The people supposedly too naive to know better mostly just held on. Priya held. Derek, who reads 3 financial newsletters and could explain the yield curve to you at a dinner party, did not. Step 2. Harvest your losses, because a downturn is basically free inventory. Vanguard estimated that a $1 million index position would generate roughly $385,000 in harvestable losses over a decade. That's worth roughly 0.85% a year to you if you're in a top tax bracket, and none of your money actually leaves the market. You sell the loser, buy something similar but not identical, and you bank that loss on paper to use forever. 2 rules matter here. You can only deduct $3,000 of losses against ordinary income per year, though anything beyond that carries forward indefinitely. And the wash sale rule means you can't buy back a substantially identical security within 30 days, which is the real reason wealthy people own hundreds of individual stocks instead of one clean index fund. It isn't sophistication. It's that owning 300 different stocks gives you 300 different ways to sell one and immediately buy its cousin. Derek, by dumping everything in a taxable panic, did the exact opposite. He realized gains he didn't want and locked in a loss he can't even use, which is an impressively efficient way to lose twice in a single transaction. And here's the honest limit on this strategy: because your cost basis drifts upward over time, the annual value eventually shrinks to around 9 basis points, which is basically a rounding error. Loss harvesting is a gift a downturn hands you, and it's biggest the very first time you use it. Step 3. Convert your retirement accounts when prices are down. Moving money from a traditional retirement account into a Roth costs you less when asset values are depressed, because your tax bill gets calculated on the smaller number, while your entire eventual recovery lands somewhere it will never be taxed again. For 2026, you can contribute $24,500 to a 401k and $7,500 to an IRA. One change is catching people off guard this year: if you earned more than $150,000 from your employer last year, your catch-up contributions now have to go into a Roth account. It's not optional anymore. Priya converted a slice of her account in April. It wasn't dramatic. She did it on a laptop, sitting on her couch, in about 9 minutes. Step 4 is the one you probably can't use, and I'd rather show it to you than pretend it doesn't exist. When valuations are down, wealthy families move assets out of their taxable estates at the bottom of the market using trusts and family loans, so the entire eventual recovery happens in someone else's name. The estate and gift tax exemption currently sits at $15 million per person and $30 million per couple, which means the actual planning problem here becomes what to do about your second $30 million. If that's genuinely your Tuesday, congratulations, that's Vivian's world, not yours, and I won't pretend otherwise. But steal the underlying logic, because the logic itself is free. A downturn is the cheapest possible moment to move an asset from where it currently sits to where you permanently want it to be. For her, that means a trust. For you, it might mean a Roth account, a brokerage account, or that cash balance you've been babysitting since March. Now let's talk about the version of all this that gets sold to you, because there's an entire industry built on monetizing the feeling of investing. Take buffer funds, which cap your upside in exchange for cushioning part of your downside. They've exploded to roughly $78 billion in assets. By fund count, they're now the single largest category of exchange-traded fund in existence. And they genuinely do what they promise. That's not the problem. The problem is the math. The largest provider charges about 0.88% a year. So you're paying nearly a full percent, giving up your dividends, and capping your best years just to soften your worst ones. Run that across a full market cycle and you've essentially rebuilt Buffett's hedge fund bet from scratch, in fund form, with a nicer app. Cash gets misread the exact same way, and you've probably seen this take on your feed. American money market funds currently hold a record $7.9 trillion. And every few weeks, somebody calls that dry powder waiting to buy the next dip. It isn't. It's yield. Short-term interest rates finally pay something worthwhile, so cash balances filled up. Those balances have essentially never predicted where stocks go next, and anyone telling you otherwise is selling you a feeling, not a fact. Even Berkshire Hathaway gets misread this way. Its cash pile sits around $365 billion, and people read that as some kind of crash warning. But the stock is only up about 3% this year while the broader market is up 13%. That gap is the price of caution, paid in real time, by maybe the most patient investor who ever lived. Which brings me to the two men who actually did call it, because their stories are the most useful part of this whole video. Michael Burry made investors around $700 million shorting subprime mortgages, historically, completely right, and if you've seen the movie, you probably already like him. Then he spent the next decade making bearish calls that mostly didn't land, exited GameStop right before the short squeeze that would have made him a fortune, and this past November shut his fund down entirely, writing that his red on value hadn't matched the market for some time. John Paulson's funds made about $15 billion in 2007. 4 years later, his flagship fund was down 36%. By 2020, he'd handed back all of his outside investor money and converted the firm into a family office. Both men were spectacularly right exactly once. Neither one could repeat it. So if the two greatest downturn calls in modern financial history have a repeat rate of 0, I'd gently suggest that the guy on your feed claiming he's positioned for what's coming next hasn't quietly cracked a problem that beat them both. So where does that leave you, sitting there with a number in your head you don't love? Let me say the part that isn't a tactic. If you're doing mental math right now on how many months of contributions just evaporated, or checking a balance you already checked 40 minutes ago, or wondering whether the responsible move is to step aside until things calm down, you're not being stupid. You're being human. The urge to sell during a decline isn't a character flaw. It's a correct threat response running on hardware built for predators, now being applied to an app that refreshes every 11 seconds. And the stakes aren't symmetrical, which is the part almost nobody tells you. If you're still working and still contributing, a crash is a discount, and you should genuinely want it. If you're withdrawing income from that money, that same crash is permanent, because every dollar you pull out at the bottom is a dollar that never gets to participate in the recovery. Same market, opposite meaning, and nobody stops to ask which one you actually are. The system isn't failing you because you're bad at this. It's failing you because it hands you a live feed of your entire net worth alongside a one-tap sell button, and then acts shocked when the two eventually find each other. Vivian's protection is that her assets are legally difficult to sell and her decisions were already made in a conference room back in January. Yours has to be built on purpose, because nothing about your setup builds it for you automatically. And if building that deliberately, instead of by accident, sounds like something you want, we run a community for exactly that, links are in the description. Here's something else worth noticing before we wrap up. You'll hear that American households now hold a record share of their financial assets in stocks, somewhere around 45%, framed as a warning sign. But that's an average, and that average is doing an enormous amount of heavy lifting, because the top 10% own the overwhelming majority of those shares. For the median household, stock market exposure is basically a rounding error next to the mortgage. So when the headlines say Americans are dangerously exposed to the market, understand that Americans mostly means Vivian, and nobody actually knows what's coming next, including me. The Shiller price-to-earnings ratio currently sits around 41, which puts it roughly in the 99th percentile of every reading recorded since 1881. That sounds ominous. Meanwhile, volatility is sitting near 15, which is calm. And current recession estimates range from about 15% in one Federal Reserve model to about 36% in another, same institution, two different models, 21 percentage points apart. That gap might be the most honest thing in this entire video. One building, two computers, 21 percentage points of disagreement about whether the economy is actually fine. So do this before you do anything else. Tonight, write one sentence stating exactly what you will do if your account drops 20%. Set your rebalancing threshold and automate it, so no human being has to feel anything on the day it actually triggers. And decide right now how long you'll go without checking your balance. That's it. That's your version of Vivian's January document. 15 minutes, and it requires no forecasting whatsoever, because a day like March 30th is coming again, and you don't get to pick the date. Vivian's phone call that morning wasn't a trade, it was a document she'd signed back in January, telling her advisors exactly what to do at specific thresholds without ever calling her. Down 15%, rebalance. Down 20%, harvest losses and convert. She wasn't consulted on March 30th because January Vivian didn't trust March Vivian to make good decisions. That's the entire trick, and you can run the same play with a plain text file. She fired herself from the job of reacting, and you should fire yourself too. Priya's index card, in her own handwriting, said, if it drops more than 20%, buy, and don't check again until June. She caught the exact same rebound. She harvested a smaller pile of losses in a smaller account. She got most of what Vivian got, minus the trusts, minus the guy paid to share opinions with her on Tuesdays. Derek is the only one of the three who actually lost money. And here's what he was really wrong about, it wasn't the market. He never even made a real prediction. He let the decision get made by whichever version of himself happened to be holding the phone in a parking lot on the worst day of the year, and that version of you is always the most frightened one, because the frightened one is the only version that's still checking. I'm not a financial advisor, and none of this is financial advice. Check every figure here against current data before you act on any of it, because several of these numbers shift weekly. The wealthy don't invest ahead of a downturn. That's the part that took me years to actually understand. They decide ahead of a downturn, and then they arrange their entire lives so the panicked version of themselves is nowhere near a phone when it finally arrives. The market will never reward you for seeing it coming. It rewards you for having already written down what you'll do, back when doing so felt unnecessary and a little dramatic. The best time to write that sentence was January. The second best time is tonight, while nothing is happening. And if you want company while you do it, you already know where to find us.